Have you ever wondered how quickly your hard-earned money could vanish? It's a thought that can keep anyone up at night, especially when we trust institutions with our savings. Today, we're going to explore a topic that sounds intimidating, but is crucial for everyone to understand: bank collapses. At its core, a bank acts like a giant piggy bank for everyone. It's a place where individuals and businesses deposit their money, trusting that it will be safe and accessible whenever they need it. This fundamental promise is the bedrock of our financial system. A bank collapse happens when a bank fails to keep this promise. It simply runs out of funds to meet its obligations, meaning it can no longer return depositors' money on demand. This is a critical failure of trust and liquidity. Think of it like a lemonade stand owner who promises to sell you a refreshing drink. If they suddenly run out of lemons and can't make any more lemonade, they've failed to fulfill their promise. A bank collapse is a much larger, more complex version of this simple scenario. Banks don't just sit on your money. They actively put it to work. This is a fundamental aspect of their operation and how they contribute to the economy. They are constantly engaged in lending and investing. Their primary activities include lending money for things like mortgages, business expansion, and personal loans. They also invest in various financial instruments, such as government bonds. This active use of funds is what drives economic growth. However, lending and investing inherently involve risk. There's always a chance that a borrower might not repay their loan, or an investment might lose value. This risk is central to the banking business model. Banks earn money by charging interest on the loans they provide. This interest is their profit, allowing them to cover operational costs and pay interest to depositors. It's a delicate balance of risk and reward. A major trigger for bank failure occurs when too many borrowers default on their loans. When this happens, the bank suffers significant losses, eroding its capital. If these losses are substantial enough, the bank can become insolvent. To use our lemonade stand analogy again, imagine the owner invested heavily in a batch of lemons that turned out to be rotten. They've lost their investment and can't make lemonade, leading to financial trouble for their business. The 2008 financial crisis provides a stark example of how widespread risky behavior can lead to systemic collapse. Leading up to this period, many banks engaged in extensive and often reckless lending, particularly in the housing market. They issued mortgages to borrowers who were unlikely to repay them. Housing prices had surged for years, creating a bubble. When this bubble dramatically collapsed, millions of homeowners found themselves owing more on their mortgages than their homes were worth. This led to widespread loan defaults. As homeowners defaulted, banks holding these mortgages suffered massive losses. The value of their assets plummeted and many faced insolvency. This crisis of confidence quickly spread throughout the financial system. Public trust in banks and the broader financial system eroded rapidly. People feared that their money was no longer safe, leading to a phenomenon known as a bank run. Depositors rushed to withdraw their funds from banks, exacerbating the liquidity crisis. The combination of massive losses, loss of trust, and widespread bank runs resulted in a major financial crisis. It was a period of immense economic turmoil with far-reaching consequences. More recently, the collapse of Silicon Valley Bank, or SVB, offered a different but equally instructive lesson. SVB had a unique depositor base, primarily consisting of tech startups and venture capital firms. These clients often held very large sums of money with the bank. SVB invested a significant portion of these deposits into long-term government bonds. However, as interest rates began to rise sharply, the market value of these bonds decreased. This created an unrealized loss on the bank's balance sheet. The catalyst for SVB's collapse was a rapid and large-scale withdrawal of funds by its customers. Concerns about the bank's financial health partly due to the declining value of its bond portfolio, prompted many tech companies to pull their deposits simultaneously. This created a classic bank run. SVB found itself in a severe liquidity crisis. It simply did not have enough readily available cash to meet the overwhelming demand for withdrawals. To raise cash, it had to sell some of its depreciated bonds at a significant loss, further eroding its capital. Ultimately, the bank could not withstand the massive outflow of funds and the resulting losses. This led to its collapse, highlighting how quickly a bank can fail when confidence erodes and depositors act en masse. One of the most critical protections for everyday depositors is deposit insurance. In many countries, government-backed agencies provide this safeguard. For example, in the United States, the Federal Deposit Insurance Corporation, or FDIC, insures deposits. This insurance protects your money up to a certain limit. In the US, the FDIC insures deposits up to $250,000 per depositor, per insured bank, for each account ownership category. This means that if your bank fails, you are guaranteed to get your insured money back. The primary purpose of this insurance is to safeguard depositors' money and maintain public confidence in the banking system. It prevents widespread panic and bank runs by assuring people that their savings are protected. This is a vital safety net. However, it's important to understand that deposits exceeding the insurance limit may not be fully or immediately recovered. While there might be a process to recover some of these uninsured funds, it's not guaranteed and can take a considerable amount of time. This is why large depositors often diversify their funds across multiple banks. Bank collapses do more than just affect the failing institution. They can send ripples of fear throughout the entire financial system. The immediate consequence is a significant erosion of public trust. When one bank fails, people start to question the stability of others. This loss of confidence can trigger a dangerous domino effect. Fearful depositors, worried that their own bank might be next, may rush to withdraw their money. This creates bank runs on otherwise healthy institutions, potentially pushing them into liquidity crises as well. Such a chain reaction can quickly destabilize the entire financial system. It can lead to a widespread credit crunch, where banks become unwilling to lend to each other or to businesses, further exacerbating economic problems. The psychological impact of fear is incredibly powerful in finance. When banks collapse, the consequences extend far beyond the immediate financial institutions. For everyday people, one of the most direct impacts can be difficulty accessing their personal money. Even if deposits are insured, there can be temporary delays in getting funds, which can be highly disruptive. Businesses also suffer significantly. They rely on banks for loans to manage operations, invest in growth, and make payroll. When banks are in crisis, they become hesitant to lend, making it difficult for businesses to obtain necessary financing. This can lead to layoffs and reduced economic activity. Ultimately, bank collapses contribute to a broader economic slowdown. Reduced lending, decreased consumer spending due to uncertainty, and a general lack of confidence can stifle growth. This affects job markets, investment, and overall prosperity. The ripple effects can be felt across various sectors, impacting everything from housing markets to international trade. It's a stark reminder of how interconnected our financial world truly is. Bank collapses are complex events, but at their heart, they are often rooted in a breakdown of trust. Whether it's trust in a bank's lending practices, its investment strategies, or simply its ability to meet withdrawal demands, confidence is paramount. When that trust erodes, the system becomes vulnerable. Understanding how banks operate and why they can fail is not just for financial experts. It's crucial for everyone. Knowing the mechanisms behind these events helps us make informed decisions about our own finances and appreciate the delicate balance that keeps our economy stable. It's about being an informed participant in the financial world. The financial system requires stability, and everyone plays a part in maintaining it. From individual depositors to large institutions and regulators, our collective actions and confidence contribute to its resilience. It's a delicate ecosystem that thrives on transparency and trust. Thank you for joining us today to explore this important topic. We hope this discussion has provided you with a clearer understanding of bank collapses and their broader implications. If you found this information helpful, please consider subscribing for more insights into how our world works.